The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman.
Hi folks, Basil Chapman, Tiger Technicians Hour, as the man said. And today being Monday, the day after the big snowstorms, when did it stop? Saturday. After the weekend of the big snowstorm, that really was a big one. Pretty big. A start of actually a little heavy snow, and then it got lighter. That's much better than the other way around. Big. Anyway, we're fine. Everybody's good. And this is Monday, February the 11th. The Dow's down 18, the S&P's up. Now, what does that mean? After all this time, you would expect that the market would be dropping. You have a reasonable person would say, hey, after this many weeks from the beginning of January of higher highs, there's just no question that there should be a pullback. Except for one little thing. And that one little thing is the psychology in the market, the one that I call the stork leg formation. That's a chart formation. But it is accompanied, and it can only come about where there is just an incredible amount of demand for buying stocks on every dip. Now, the day is young. It's the beginning of the week. I'm anticipating that this week we actually do see some kind of at least a short-term signal to say we're making some kind of a top here. It's first, of course, I'm very cautious about turns. I don't like to proclaim too early that this is the big one or anything like that. But all I'm looking at is there are just so many stocks. For instance, let me just run. I'll give you the numbers and then I'm going to run down what I'm looking at. Dow's minus 17 at 13,575. The S&P is 1516, down $1.25. The comp index is down 2 at 3191. Gold is down huge, down 16. You know, that dreaded H pattern. You just, I don't even know. It just seemed to me that gold might not have a major sell signal in the sense that it's kind of crash material, but there really looks like the GLD made 185.85 high back in, I should have typed that in, back in September of 2011. So we've already gone 12011. We've already gone a year and a half since that high in the GLD. Well, the low was 148.27, then it bounced, came back down, went to 148.53, bounced, didn't make a new recovery high. Now it's sitting underneath the 9-period moving average in the 9-period moving average in the monthly chart. Monthly is not even halfway through. But look at this. The MACD that's a bullish MACD if you're a bear. In other words, it's very bearish. But look at this. The stochastic failed. It couldn't even get up. It couldn't confirm that rally. In fact, it made a much lower high on that rally. The unbalanced volume is negative. So I don't like this. Relative strength is starting to fade. These are the indicators that I always have up on my charts. Volume is not. To me, volume is showing when it made the top. Let me just double check. That was the top the month before the top, August of 2011. A huge volume, and they're very big, but not huge as big a volume at the top. But what I'm looking at here is there's just nothing. So it says to me that the institutions aren't really buying the GLD. It doesn't look like it. So if money is coming out of the harbinger of fear. I always call it the harbinger of fear, the traditional harbinger of fear. That's if any of you had relatives or friends who were from overseas, especially over the last 50, 60, 70 years, anyone that you've had contact with knows that during periods like the World War II and other periods that are similar, gold is most non-Americans would buy gold just to store it, just to keep it around. I mean, I have family, my wife has family that survived the war because they had gold in their shoes and they had pieces of gold. And I mean, that's the traditional. So I'm looking at this and I'm saying, okay, if gold is starting to decline underneath the 9-period moving average, if this is the third month in a row, if we haven't finished February, but if it does go underneath the 158, which is the real important 158, very short term, 158 is the level to watch. Goes under that, then we're looking at something else. Then you should see a very quick run to the downside. So it's a very important period for the GLD. So when I look at that, I'm saying to myself, if gold just comes back to 148 from 159, that's about 8%, another 8 or 9% down. That's still a pretty big decline. And we will see, because what will the gold stocks be doing? Will they have started to turn? That often happens. Gold stocks, either gold goes up without the gold stocks and then they follow, or gold stocks go up and gold doesn't do anything. And then once in a while, they're actually all in sync. There's a funny thing about gold. It's like the stocks and the commodity from which the stock should be acting upon. No, they don't quite do that. So, going to watch this real closely. Maybe later on I'll look at the XAU, etc. But at this particular point, gold is down, and we've got the dollar up, but the dollar's not up. It's only it's down 0.05. I'm going to talk about that as well, because bonds are only up 0.01. Now my three bears are VIXI, Dolly, and Bondi. So let's go through that. And crude oil, let me just do that before I forget. Crude oil is down. No. It's up 17 cents. I thought it was up. It's up 17 cents, 95.88. I would have said that was a quick move. And high-grade copper is down 3 at 372, stuck in that trading range. Now, this is going to be very important. 877-927-6648. That's very important. That's the number to call. Now, when I'm looking at this, as I said to subscribers this morning, for the last week or more, but if we're looking at the IWM, at all-time highs. Do you remember the stories when we were going to all-time lows? Well, not all-time lows, but recent lows in the 6,600, 6,500s in the Dow, 6,666 in the S&P. Remember those headlines? Where are the front-page headlines here? Isn't it enough crazy? It's just an incredible phenomenon. As far as I suppose the phenomenon is incredible. It's an amazing axiom that the press only wants bad news. That's how they sell newspapers. Are they going to sell newspapers if they say Dow 150 or whatever it is points to 14,191, whatever, say 200 points from the all-time high. That doesn't sell newspapers. It just gets people upset because they say, oh man, I was speaking to people over the weekend. They said, a guy turns around and says to me, Oh, that's right. Don't you do something in finance or something? I said, no, I have nothing to do with finance. I do the stock market analysis. That's what I say. Nothing to do with finance, just stock market analysis. I do the X-ray of the chart, technical analysis. And he said, whoa, how come with all this stuff going on, he says, how come our portfolios are doing so fantastically? I said, because there is no relationship. If you look at 1932 to 1937, 1938, can you imagine the horrible news with the drought and poverty and no food and deaths and houses, people just having to leave their homes, they couldn't afford it. Then you get the Dust Belt. Oh, geez, the New York Times every single day. Would you have bought a single stock? No, and yet it was up 500%. I said, you've got to get that media out of your mind, because it's just going to mess you up. That's the chart I was going to show Friday that I ran out of time for. Not going to show it. IWM, all-time highs. IYT, all-time highs. I think this is a real tough one. To be very conservative, I could call it peak C. But if I'm not that conservative, I really am calling it leg B. This is the monthly chart of the transportation index, the ICE's Dow Jones Transportation Average. Now, all of this being said, that's not to say that I'm not expecting a sudden, quick, and sharp pullback at some point pretty soon. I don't know if we've got there yet. There's a pattern that my subscribers and I are looking at. We're going to go through this in great deal, all these different patterns. We're going to go through in my webinar coming up Wednesday night for all my subscribers, and anyone who's got the 2-week free trial. Please, you're welcome to come to this particular webinar, Wednesday night, the 13th, 6:30 to 7:30. Now, what's really important is, so you've got the IYT. Now, lagging is the 2,000 plus New York Stock Exchange. It's in leg C in the monthly. That's what I'm calling it. But it is way under the 10,387 high that was made back in 2007. It's at 89.20. 89.20, that's, it's 1,100. That's a lot of points to get. Will it get there? Well, this is the part that I'm looking at. 9,687 to 9,245. That is a 400-point wide rectangle formation that I've made there. That says, you know what? I think it's going to go higher. It doesn't necessarily have to get to the all-time highs to at least be helping, but not hurting. That's the most important thing. The S&P, now look at this. This chart is, to me, look at this. Here's the S&P. So what did I do? I found a chart that I showed my subscribers a while back. I said, I'm a little embarrassed to actually show this chart. I wonder if I'll find it. I'm a little embarrassed to show this chart. Yep, this is it. It's got nothing on it except a technique that I've used periodically only when I absolutely feel that I need to find a synchronicity that is so common within a chart that I can use it, not with impunity, not nonchalantly, but I've got to use it in a very organized way. And that had the decline. You see these little lines over here? Well, that had a measured move from one side to the other. And it happens 3 times. And where does it come out? It comes out, if it's an exact measured move, it comes out to January of 2013. I have another technique that I use, which is called the left side, right side price time move. What is that? And this is what I'll be doing on Wednesday night as well. I'll be showing which chart patterns in my methodology, in the ChapmanWave methodology, which chart patterns actually work the best at certain times. In other words, what I do when I have my Master Trader series, what I often do is I show charts and then chart patterns that I expect for the next 2-3 months will be the chart patterns that we need to look at. So this is what it means. That you can take, look, here's a 5-year gold chart back when it was making its low. I'd done this a long time before that. In fact, I used it for this particular CD. Look at the 5 years from that high back in 1996 to the low of 2001. You get an exact 5-year time span to the right. You get the inside wedge, that light green line that you can see if you're looking at Tiger TV. That's the technique that I'm using. And what does it say here? It says, look, you could make an all-time test the old high in April of 2013. I'll be right back. Take your call to 877-927-6648.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Folks, we're back. Yes, the Dow is now down 20. S&P's just minus 55. See, this is a very important phase, and I'll explain why. There is a mindset that says, at a certain point, oh my goodness, I've missed a major move. Just think of all the people that have been shorting all the way up from 6,600 or 6,500 in the Dow, or 66 in the S&P. There are a lot. I meet a lot of people. They just keep talking negatively over and over and over. Elliott waivers. There are people doing Elliott wave who have misunderstood a lot of this and keep getting readings, at least if not getting them short, although a lot of them are talking about the end of the world, have missed a lot of this move. There are fund managers who really got very nervous at the end of last year and got out of stocks. So I'm looking at a situation right now where near term, I think sentiment and other things are saying to me, whoa, be a little careful here. The stocks that you want to buy are either breakout stocks that have had fabulous earnings, have broken out and now become darlings. I'm not going to mention this particular one, which we made a whole 10 cents on, and then it moved up. It's now up about 22% in 2 days, and without us, because I made it stop a little too tight. And then I want pullback. I want to go with my thinking that says I like the stock. It's in B or C. I missed some of the move, but if it pulls back, I can at least ride it with a nice percentage gain to leg D. And then I just have to raise the stop or get out and take a nice gain and keep building up gains, because we are going to be pulling back at some point. So let me just go through this now. The three bears, VIXY, that's the VIX index. Where did it disappear to? Where did I type that? In the wrong place? Right here. VIX.X. Made a peak D, a very quick, in the ChapmanWave methodology, when a price movement goes very quickly from an identifiable low bar, in this case on the 23rd at $12.30, $12.30, very quickly to peak A, to peak B, to peak C, and then to peak D. In fact, this is 1, 2, 3, 4, 5, 6, 7, 8. 8 is the shortest. There's my example. Let me write it in my book. I'm sorry, I have to take time. I've got this incredible book that I've built up now of all these examples. And the very first page says, very quick, A to D. Is that what it says? That's the heading? It says AD. Very quickly, I have A to E and A to F. There was a weekly chart that went to A to F in just an incredibly quick time. So this is A to D, and it's the VIX index daily, and it starts on the at 12:30. Is it double bottom? Oh, 12:28. That spoilt it. No, 12:20. No, the actual start of it was there. Okay, so this is 1:23:13. 1:23:13 to D. And that was basically, it was like 9 bars, 9 times. Look, you go, A is leg 1, peak A is 2, leg B is 3, peak B is 4 down, 5 has to be C, 6 is makes peak C, that's the leg down to make C, and then 7 gives you the 7th bar, gives you leg D, and 8th bar gives you peak D. That's the quickest you can do it. So that is really quick. But the market is now going to recovery highs, all of them, and the VIX is not going to recovery lows, or whatever you call it, to lower lows. 12.29. Was it 12.29? Yes, 12.29. It hasn't gone to a lower low. So that's number one. Number two is the TLT is holding pretty well. It has not broken down. It hasn't climbed into the 118s that I've been talking about, 118.70s already, where it starts to show quite a bit of strength. But it hasn't broken to lower lows at trough G. So I'm watching that. So I'm saying, got all your little ducks sitting there. And then the final one is the dollar. The dollar is acting very well. It's in leg A. I could use that as a phantom peak. Let me just double check here. 80.28, 80.28, yeah, two parallel high bars and a breakout. You know what, to be a little conservative, I will call this a phantom peak A. I always like to get there a little sooner than later, and that's B. So let's just call it B. It could be A, it could be B. But, most importantly, the weekly chart is making higher lows and not low lows. So now I'm saying to myself, aha, let's look at the EUR-USD. And the EUR-USD currency pair has made a peak D, ChapmanWave, remember, from the lowest low bar, you go A, B, C, D, at 1.3, in the 1.37s, and it's pulled back sharply. But leg D in the weekly, in that left side, right side price time match. We'll talk about that more when I get back. We'll also be back with Neil in Denver. Be right back after these messages.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi everyone, Basil Chapman. Dow is down 19, S&P's down 1, and we're going to go to our first caller this week. It's Neil in Denver. Hi Neil, how are you?
I'm good. How are you, Basil?
I'm very well, thank you.
That's good. I was calling, I seem to be a bit focused on the financials, as they seem to have led the market up, certainly over the last couple of months, at least from what I can look at. Almost out of the abyss, effectively. But anyway, I'm just wondering, Goldman seems to be the lead dog, certainly in the financial side, and just wonder if you could give me your insight in terms of what the pattern looks like on a daily basis, as well as the wave counts.
Well, number one is I think that Goldman, it took a long time. It took a lot of threats. It took a lot of whatever. But I think that Goldman is back as a leader. So I think you've got your eye on the right stock. If you're looking to buy Goldman, the big problem I've had with Goldman is that when there is a stock, this is a technique that I use all the time, but it makes entering the stock, you just say to yourself, am I going to be the one that buys the top? This is what the problem. But as long as it walks the 9-period moving average, there shouldn't be a fear, because it just keeps walking that line. So that line right now is at 149.66. It has not closed under it since there was just the moment it broke above it. That was back on the 11th of December. There was just a moment where it slipped underneath for one close and then one and two intraday moves. And then it said, whoa, I don't like to be underneath that 9 EMA. I need to walk that 9 EMA. And there it's back again. But now I have to look at the MACD and the slow stochastic. They're kind of running out of room. The same as the XLF is an alternate wave count here. I've got the XLF as G/B. But I don't... That is also walking the 9-period moving average. I agree 100% with you that the financials have given many of the fund managers the security of saying, as long as the financials are doing okay, I think I can get back somewhat into the market. Well, this is the issue that I have. The weekly chart on Goldman Sachs, folks, GS is the symbol. Goldman Sachs is at 152.19, up 59 cents. Even today, when the market is just kind of trying to feel its way as to which way to go, Goldman is up 0.39%. So this is the way you're looking to go long. Is that correct?
No, actually, I'm on the other side of the equation. I'm just waiting from a timing basis. I'm also looking. I'm looking at Goldman, the pattern on the daily basis, and it looks like you've got the oval. Also, I'm wondering if we have the neck of a stork leg pattern developing.
Well, if you're looking at, are you looking at Tiger TV right now?
I am, yeah.
Okay, you see that I drew the body in. In fact, let me just show the folks that we're talking about.
Right.
LEG, that's the leg. It isn't a leg, it is the leg of the stork. In other words, a single, thin, spindly leg that goes up, and then you get the body. I usually like the body to be a bit longer, so although I've drawn in the oval, my preference really is for what the Dow and the diamonds actually right now. This is the perfect, taking time, with the potential to break to the upside, make the neck, the head, and then whoops, go right back again. That's the beak that comes down. So let me just go back to the Goldman drawing. This says that we are in leg D. Now, so when you say on the other side, you would go short Goldman?
No, I probably would go short the
XLF?
The XLF, or actually I'm looking at buying puts on the FAS because, quite frankly, I think I've lost faith in the reverse ETFs. It seems to me that for almost the same amount of money,
right,
being short the FAS, you actually can get some pretty fair leverage to the downside.
Yeah, as long as you're right.
Well, as long as you're right. That's
yeah.
No, you're right.
Okay, let's do this.
Right on there.
This is what I'm going to recommend then. Here's my strategy. I need to see how the day closes. It's between today and tomorrow that if there's any up spike at all, that should have bears just throwing up their hands and saying, oh, I've had it. I'm going to buy. And that could take us into Monday, Tuesday, maybe Wednesday. It doesn't have to even be that long. It could just be one sudden move towards the old highs. I got a feeling we're not going to make the new high. I mean, hit the old high of the Dow at 14,198, I think it was. I think we're going to fail underneath it, and then we're going to come down. So here's which option would you go out to March? Is that it?
Well, actually, I'm not adverse to buying the longer dated options that are deeply in the money. So I'm thinking about April just because there's a lot of political nonsense.
Okay.
March 1st.
No, I'm with you, actually. Right. And if you're deep in the money, it really doesn't matter. You don't have to go too far. You don't want to be too soon. I think you're right with April because you're going to be moving. You won't be moving point for point, but you'll be moving at about, say, it depends at which point they start to meet, but you'll be at about 72% or something like that, and then it'll get closer and closer the more accurate you are in that the price comes down. But what I'm thinking here is this. I haven't got peak D in Goldman Sachs. Mm-hmm. That needs one lower high bar. That could be tomorrow. If it doesn't go above 152.63 tomorrow, that'll be D. That isn't really good enough. I need to see price destruction. I really need to see in this particular sell-off that we're going to have. It has to all happen really quickly. So I don't have to tell you that if you would use the FAZ, let's say, FAZ. So FAZ is down.
I would use the FAS. The FAZ for me is just not going to work.
No, you're right. So So what you would do is you would trade FAS, which is 200% long the XLF, the S&P Select Financials, and you wouldn't sell calls, you'd be buying puts.
Exactly.
And the puts that you would buy would be deep in the money. So if there's any movement to the downside, you will be participating with the most security because you're able to watch the stock and you're able to cap it whenever you want to just get out. But in the meantime, the price movement to the downside will be not exact, but close enough for you to be in the trend, and that's the most important thing. So here's my thinking. FAZ, let me just do a quick analysis of this. Should be the same as the XLF, but sometimes they're different. I had a different lettering in the diamonds, so I'll just do this. Take 1 second. I tell you why I want to do this, because it's going to, the FAZ is also going to, FAS is going to give me a clue, as well as the FAZ, because I like to use the inverted indexes, because 108, 127, because sometimes, I always ask people when I have my Master Trader series, I always say, are you much more comfortable shorting or going long? And every once in a while, people just look at me as if to say, well, what are you talking about? And then I say, all right, let me phrase it a little differently. Do you succeed best going short or going long? Because you'd be surprised. There are some people, we have people right here in the den, we have people that call the show who are really very good at shorting, or some are just never short. They only want to go long. But once they got introduced to these inverted funds, they could look at the fund that was a short fund and treat it with the same psychology that they had looking at a chart as if it was rising. Do you know what I mean?
Absolutely.
So, I'm doing this chart. I'm going to give that an instant restart. A, B. Yep, I get exactly the same thing. So this is what I'm looking at, the FAS, which is at 149.69. Because you are, would you layer your positions, or would you just put it on and that's it?
Oh no, I will manipulate this thing pretty heavily. I'll buy April's deep in the money. I'm already long a few March in the money puts, and if need be, I'll just keep rolling it back out. I also can hedge it by buying the FAZ if I find it. We get to a point where perhaps I need to hedge or to buy it.
Okay, good. Okay, so you're
all sorts of things I can do here.
You're very conversant with this. So here's what I want you to do. Look at the FAS. I need just to I'm going to use Goldman just for a brief second here. I want to change it. I've got peak C. Well, I've got leg C in the 120-minute chart. So far, and the day is really young, but so far, it seems like the market is just testing support. If the market goes to lower lows than the S&P and the Dow in the next hour or two goes to a lower low than it's already made today, then I'm going to watch this really closely, because then I might be close to seeing some kind of a sell signal, which I would then think will go to a sell mode. But I always start with a sell signal. I don't want you to be a little too early with this, although because you're already in it. So this next position, this is what I'm looking at. I would do this. The FAS, and I'd like to base it a little bit on Goldman, but the charts look pretty close, is making leg D. If you have the patience, A, B, C, I've got exactly the same thing now in the 120-minute chart. There should be a D. But I'm going to suggest that if you want to just nibble, I really mean nibble, just to start another tiny position in the April series, somewhere around here at 149.65, I think would be good. Why? Because at this particular point, another 1.5 to 2 points to the upside, if the turn comes, then Goldman should come back really quickly and go to 146.10, which is underneath the 146.39 9-period moving average, and suddenly you've got something that says, great, now I've got peak D. I have a lot of things in place that say that if this is going to work, immediately you want to look at the volatility index, and if that volatility index, which is at 13 now, starts to bounce and gets to 13.80, but you want to see it in the 14.30 and then quickly go to about 14.75. You want to see it in that whole 15s area. Because if that's going to happen, this market's going to pull back sharply. But if the volatility index stays here and the TLT is at 117.06, if it can't get to the 118.70 area by Wednesday or Thursday, the dollar can't do it on its own. Let me see what the dollar is right now. See, the dollar is now making a doji candle. It needs to hold very strongly. So you've got only one out of the three bears that I'm looking at, VIXI, Dolly, and Bondi. That's bonds, dollar, and volatility index. So I don't want you to be too early. Mm-hmm. So all I'm saying is once you say to me you've already got a position, I'm going to say to you, why don't you hold off a tad longer, see what happens by the end of the day. If Goldman Sachs is above 150, what's the high today? 156. If Goldman Sachs is above 152.90, I would not short it just yet. I'd have to wait until tomorrow. My guess is then we'd be looking at either late tomorrow or Wednesday as the possible turn, if the turn's going to happen right in the next few days. So I think you're right. I think you're going to be correct looking at the April. I'm also suspecting that the pullback is going to be sharp, quick, deep, and then you've got to take your profits and you've got to step aside, because there are just too many people that have missed this move. I think there's going to be a lot of support in the downside. So I think you've got the right move. I'm going to look at this. In fact, I spent the weekend looking at pretty much the same thing that you're talking about right now. I just don't know if I want to step in at this particular moment. Not only that, Neil, if you do miss the move, once we're looking at a 12 to a 15, well, let's call it a 10 to 12 point pullback in Goldman Sachs. If you miss a point or two, that's just not a big deal. You want to get the trend. And the reason why I'm just hesitant to say to you, absolutely, this is the perfect time, is because I haven't got the signal yet to say that we're reversing. I'm close, but I haven't got it. Could be the end of the day. Could be tomorrow. Could be Wednesday. I don't know, but I think we're real close. And once the trend changes, watch those three things. You want to see the TLT in the high 118s. You want to see dollar continue to lead, and you want to see gold continue to pull back, and you want to see the volatility index move at least to the 15s. But actually, it needs the 16s to sustain a down move. So, good eye.
And Basil, just from a pattern standpoint, you are seeing Goldman. You're seeing the neck, obviously, above the body. So you still want to see, again, the beak head form with it's a bit of a consolidation, and you want to see the Dow get into that neck, at least neck mode, which is probably another 3 to 5, 7 days away. So
no, actually it's not. The 120-minute chart is in leg B, making peak B. That should go to C and a D. It could fail, but this is what I'm anticipating. And as I say, my target here is for the Dow at least to get to the 14,000s, so that you can see headlines saying 14,000. Finally, the Boston Globe will probably put a nice big fat thing on saying 14,000. But that's what I'm looking at. But I've got tremendous strength in the Goldman Sachs weekly chart and even the monthly. So this is a shorter-term trade. That's why April is good. But I suspect you'll be getting out way before April. It'll just be a quick run. Hey, thanks so much for calling. Yeah, we'll watch this together.
Thank you, Basil.
Thank you.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Great moments are born from great opportunity, and that's what you have here. The opportunity to answer the questions, should I buy or should I sell? Should I be in or should I be out? Hi, I'm Steve Rhodes with TFNN, and I've produced a free report, Reading the Message of the Markets, where I'll teach you how to use a set of tools that will answer these questions. Go to the homepage of TFNN.com right now and download Reading the Message of the Markets. This free special report includes step-by-step video examples that would have had you out of the market before the crash of 1929, before the crash of 1987, and would have had you back in the markets buying at the bottoms. This set of tools works on all time frames and all instruments. This set of tools will shape your trading and investing future. Folks, this moment will never be here again. The only cost is not taking action. You were born to be a money master, and the time is now. Go to the homepage of TFNN.com and order Reading the Message of the Markets.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. We're back. I want to put a couple of things in perspective here. Crude oil is up $1 at 96.82. It's moving real quickly right now. I don't know if I'm behind or I don't trade it, so I don't know if I'm 5 minutes behind or, but that's what I've got. There's a pattern that I look at. It is a channel pattern. This is how I developed the one that I call the falling axe pattern, which is an expanding cone, which is I've hardly ever seen it discussed per se. What people always look for is the exact channel, so that you've got parallel sides. So it's the same principle. I have a slightly different slant on the results, but that's not the issue. The issue here is that if crude oil, which is trading now at 96.83, is able to get to 97.26, and this is one of the reasons why I don't want to short. We did that just briefly the other day when I went to peak D in the Dow, went short, and I had to cover it real quickly. Very small, I can't remember, 1.8% loss or something like that. But I don't want to be early. And I'll tell you why. If crude oil, which has made peak C in the weekly, actually starts to climb, and if it gets anywhere into the 97.50s, I think it's going to retest the last high of 98.24. This is now the March contract. Now, I have no idea what people trade, which contract, you can backwardation and all that stuff. But if it breaks above 98.24, you've started leg D up, and then I've got that left side, right side price time match, which targets March the 15th. It targets the recent high, not recent, but September high of 101.78. So I just don't want to be early. And my thinking here, now there are two ways of thinking about it. I had an email from someone who does fabulous technical work, who said if crude oil goes above, and I can't remember, if the price of gasoline goes up, and he gave me a price, I can't remember what it was, that has invariably affected the market negatively. So I'm looking at this, and all I'm saying is that if crude oil, which at this particular point is acting pretty darn well, considering there's a high-level consolidation, actually breaks above that 97.50s, then all of a sudden you've got the left side 101 as 98.24 as a target. But if it breaks it out, that begins what? A new leg A or B or something in the weekly, in the daily chart. The weekly is in leg D, and the next resistance is at 100.00. That'll be next week. So crude oil needs to really decline sharply, and it needs to get into the 94.30 to 93.70 area. Then all of a sudden I'm saying, aha, now we're looking at the euro, which has made a peak D. Crude oil is pulling back. USD JPY has made a peak E, but is acting really strongly. Look, walking the 9-period moving average, made that oval formation. This is the neck that keeps extending. Weekly chart is just, you've never seen this before in the USD JPY. This is just an unbelievable move. It's weak, of course, strong on the chart, weak in reality. The higher it goes, the weaker the currency gets, but this is the USD JPY. And I'm looking at it, I'm saying, hey, don't get too carried away. The volatility index is still saying there's buying pressure. So let me leave you with that, because now we're going to have fantastic analysts coming up. This is Larry Pesavento. As soon as the break comes, he'll be taking over, and love to hear what Larry says. Always terrific work that Larry does. We got great analysts right through the day. You got Larry, then you got Darren, then you got Daryl. Then you've got Daryl. Then you've got David. Then you've got Ken. And then you come to Tom O'Brien. Wraps it up at 4 to 6. So fantastic programming. So let me go right back here to this. This is the chart that I'm looking at. I don't know if it's going to be right. This is the 120-minute chart. He says that there should be a pop above 140.03 on the Dow Diamonds. Should make the neck formation. And at that point, I got to be careful, because we could get the turnaround. The Dow right now is leg E. The S&P is in G/B. So I have some mixed signals, but so far we'll see. Have a great day. I'll be back tomorrow. Don't forget my webinar.